Hello, this is Andrew Westhof with Homes Mortgage Lending, and today I want to talk to you a little bit about some mortgage math, specifically how your payments break down with amortization for principal and interest each month, and how extra payments will affect that amortization and paying off your loan faster. So let's take a look. So amortization is just the breakdown of how much of your payment is principal versus how much is interest. So let me give you an example. I use a $400,000 loan amount at a 6% interest rate on a 30-year fixed. 6% was a little bit arbitrary. The reason I picked that interest rate is because it makes the math on a monthly basis a little bit easier for me to show you on a calculator quickly. So when we figure out your monthly payment, we do some math to figure out how much we need you to pay in principal and interest so that your mortgage pays off in 360 months on a 30-year fixed for 30 years. So every single month you pay a little bit more interest and a little bit more principal, but that's just the nature of the interest rate you're paying. So at this 6% interest rate, what you're really doing is you're paying 0.5% interest. 6% divided by 12 is 0.5% of each month on the remaining principal balance. So this is the breakdown. Of the first month it's $2,000 interest, $398.20 principal to get that $2398.20 payment, and then the next month $1998.01 in interest, so a little bit less, and a little bit more, $400.19 in principal. So it kind of gets snowballs, and the longer you're in the loan, you pay the principal down, so you're paying more principal than you are paying interest, because the interest you need to pay on the remaining principal is lower. So let me just show you the quick math on this so that you know I'm not making any of this up. So if you have a $400,000 loan, and per month, again, that's 0.005, 0.5% interest, there's that $2,000. So we subtract that out from this total payment, and that's the remainder, because we already did this math and we know that's how we need to break it down to get it paid off in 30 years. So again, let's do it for the next month. So now the remaining principal is this $399,601.80. $399,601.80. Again, 0.5% is on the monthly basis. $1998.09. So we'll round that up a penny to get to $1998.01, and then subtract out the difference is $400.19 for the principal. So we're just doing that every single month for 360 months. When you close down your loan, you actually got a breakdown of how those work every single month. So now let's say, hey, I want to make extra payments on my loan. What does that look like? So let me show you two examples. So the first example, I'm gonna say that you bought this home, you had a bunch of expenses for moving, furnishing, you drained the savings account for your down payment, so you wanted to build up your savings again before you started making extra payments. But in year 2, so month 13, the first month of the second year in your mortgage, you said, I'm gonna make an extra $100 a month payment on this scenario. What you end up doing is over the next really 29 years, since that's the remaining term of your loan, you're going to save $60,873.20 in interest, and your loan's going to pay off 37 months early. So not too shabby. So this $60,873, that's after the $100 extra. So this 37, so what we'll do is take 37 times the payment, which is $2398.20 times $2398.20. So that'd be the remainder of the payments, $88,733.40. So you're actually saving the $60,873 is after we've figured in the month that you've already paid extra, because you now at this point your loan's paid off and you don't have to make that extra $88,000 and change. But this is just the interest savings portion of that, if that makes sense. So now let's say same loan scenario, but let's say from day one you decided to start making an extra $100 a month payment from the first payment. So now your interest saving is $81,415, and your loan's going to pay off 47 months early, so 10 months earlier than if you would have paid that extra $100 a month starting in month 13, starting in year 2. So that difference is $20,542. So really what you did is you spent an extra $1,200 in the first year, and it ended up saving you $20,542.20 over the life of the loan. This isn't to say that you're wrong for not making extra payments initially on the loan. Everyone's situation is different, and you want to certainly make sure that you're comfortable with your budget and finances before making extra payment. My whole point of showing you this is to show you how much the earlier you make extra payments on your loan, the bigger effect that it has on your loan, and it can be pretty large. And the reason for that is, say you make an extra $1,000 payment on the or $400,000 loan at 6%. What you're ultimately doing is the payment's going to stay the same. So now you've got that extra $1,000 in principal that you're still paying, that you're no longer paying 6% interest on. So the amount that because your payment's now based on that bigger loan amount, so the amount difference on that payment is now automatically going to principal every single month. So the longer that happens, the more of a snowball effect that it has. So I want to talk a little bit briefly here about the decision whether or not you should make extra payments on your loan or not. You may have heard people say things like, especially if your interest rate's really low, that you should be investing in the stock market versus making extra payments on your loan, things like that. Currently, interest rates are a little bit higher, so now there's certainly more of an argument to make extra payments on your loan versus investing. But I think that a lot of times the financial gurus out there and wannabe financial gurus, because there's a lot of bad advice out there, they don't look at kind of the full picture and look at you as a human with your situation specifically. So what I mean is, when I talk to people about whether or not they should make extra payments on their loan, I'm talking about their financial goals from when they want the mortgage to be paid off. I'm a loan officer. I don't look at investments in the stock market. However, I do know some general things where the rate of return is in the stock market, and how you should set up your savings for retirement. But those are really two separate things. So if you're looking at them on the same kind of plane, really the only reason that you would do that is if you're kind of looking at, hey, I've got an extra $500 a month, and I'm trying to figure out what I should do with that. And if you're thinking, well, I have a low interest rate on my mortgage, I don't really care if I pay it off fast, and I've got this extra $500. Well, in that case, yeah, you probably shouldn't pay extra on your mortgage, because it doesn't matter for you to pay the loan off faster, because that's ultimately what you're doing when you're making extra payments. You realize that savings in equity in the home and no longer having to make a mortgage payment once it's paid off more quickly. So what I mean is, when people kind of look at the total finances of whether they should pay their loan off or not, I think a lot of times you get a little stuck in the weeds of what you're actually doing. What you're actually doing is creating a large savings and interest by paying extra to pay your loan off faster. So for me, I'm lucky. I bought my house in 2019. My interest rate is very low. So from that standpoint, you'd think, well, you should be investing more in your retirement fund and less in paying off your home. But I already set up my retirement fund. My budget already had that in that when I bought the home. And I want to pay my home off before my son graduates from high school, around when he graduates from high school, which is about 12 years from now. So I am paying extra on my mortgage so that can happen. Because if I took that extra, it's about $300 a month. If I took that extra $300 a month and put it into my retirement fund, sure, at the end of the day, when you look at my total financial picture, yeah, I'd probably have more money. It made technically more sense. But when my son graduates high school, if I'm trying to help him with college and other expenses and things like that, I'm not going to dip into my retirement fund and pay the penalties for doing so. So I'm wanting a certain date for my loan to pay off, and that's why I'm paying extra. And I already have my retirement goals, and I'm meeting those goals separately. And that's what I think the vast majority of people are doing with their finances. It's two kind of separate things. It's different times of life when you're looking at paying off your mortgage. So I think that it's fine to make extra payments even if your interest rate is low. You don't really ever hear people complain that they paid their mortgage off sooner and that they would have had extra gains in the stock market. People aren't really looking at it that closely. And the nice thing about mortgages is when you're paying extra on your mortgage, you're realizing whatever your interest rate is on your loan, you're getting that gain every year that you have the mortgage. So it's a guaranteed rate of return, which is also pretty nice. And I think a lot of people, when they're thinking about paying extra on their loan, it's not usually like, I just all of a sudden got a raise and I've got $200 extra a month. Maybe it is, but a lot of times you're just kind of looking at your finances and going, yeah, I could probably afford an extra $100, an extra $150, $200, whatever the case is. If you decided to not pay extra on your mortgage, I think most people aren't automatically going, oh, I didn't pay extra on my mortgage, so what I need to do is I need to increase my retirement savings. Some people might, but most people, I think that money now is either going to be spent, probably in most cases, or it's going to go into savings at a very low interest rate of return. and you're not paying anything off early. So I think it's a good idea. If you want to talk about your specific situation and you're located in Michigan, you can certainly reach out to me. All my contact information is in the video description, and we can go through and run some hypothetical numbers. I can send you a Excel spreadsheet that you can play with the numbers of how much you need to pay off per month to or additional payment you need to make to pay your loan off at certain time periods, and play with those numbers to kind of figure out if you have a certain goal in mind of when you want the home paid off to do that. And then one extra caveat, because I love to be long-winded and talk in very much detail. Another thing that people a lot of times think about when they're thinking about whether they should pay their mortgage off or not is they kind of think about it correctly and go, yeah, what I'm really doing is paying my mortgage off faster. But they may think, well, but I am not going to pay this mortgage off because I'm either going to sell this home in 5 years and upgrade, or I'm going to probably refinance because rates are high right now. So if I'm paying extra, yeah, I might realize my return, which my interest rate say is 7% today, but if it drops down to 5, well, now that extra money I paid, I'm only gaining 5. So is it still worth it to me? I think that those are certainly things to consider. But it's still not a bad thing to pay extra, because in the first scenario, if you're going to sell the home and buy a new one, well, now you have more equity in the home. That gets a little bit more tricky to kind of figure out and talk through. So if you're, again, in Michigan and you want to talk through it, we can certainly do that, because one thing we're going to want to consider is how soon are you going to be buying the new home, and should we maybe be getting the savings built up in case you decide to buy the new home before selling the current home. And there's some other variables that go into that. Now, in the second scenario, if you're thinking about refinancing, well, nobody really knows when the rates are going to drop, how far they're going to drop, and when you refinance. One thing I do want to tell you is that you can set up a term on your loan when you refinance, so you're not setting it back to a 30-year fixed and kind of starting over. We can set it to whatever term that you want. Or if you don't set it to that term, almost all loans these days, conventional FHA, VA, always check with your lender, but most loans don't have any kind of prepayment penalty. So you can already just do the math and figure out what you need to keep paying to make your loan pay off in a certain time. Because I think that's the biggest goal, is when you're thinking about making extra payments, is what's the actual goal of when you want the home to be paid off. So if you go, well, if I go from 7% to 5% and I'm paying extra, well, now I'm not realizing as much of a return on the extra amount that I paid. That's true, but the great thing is on the remaining principal balance, your interest rate payment is lower. So now you have more gain overall just because your monthly payment is lower. And then if you want to look at it from I'm setting this up to have my loan pay off faster, and your loan was going to pay off, say, in 14 years based on the extra payments you were making at that point. Well, if you just take the savings that you made and roll them into the new loan, meaning you add on whatever your monthly payment drops by to the new loan to keep paying it lower, well, that's going to reduce your payment, your time that you're going to have it be in that loan even further. And we can obviously run those numbers, but if you go, well, now I'm at 10 years, well, that's great. You didn't change anything to do with your finances month to month at home, but you're going to have that loan pay off even quite a bit more quickly. So again, I'm getting in the weeds a little bit. If you want to talk through your specific scenario, reach out. I hope this video has been helpful, and I'm going to continue to make videos like this. So if you did find it useful, please subscribe, like the video so other people can find it, and I look forward to seeing you on the next one. Thank you so much.